Hello, welcome back. So, does Alibaba actually have issues allocating its capital? It seems like this may be the case. Return on capital employed that seems to be getting lower. And this article is actually claiming that Alibaba has troubles ahead. So, we're going to examine what this means and whether this is actually accurate here. Now, we will go back first and kind of take a look at what is going on with Alibaba right now. It's been relatively doing better, actually, in the past few weeks or so. You will see that in the last 6 months, obviously, it has fallen a lot, but lately, the last month, it has been growing higher overall. Now, if we take a look at the news about Alibaba and generally speaking, the markets here, you will see that Alibaba Group drops again as Chinese ADRs pull back yet again. And this is what happened today. It actually fell almost 2% during the session actually yesterday and today. It kept on falling, and actually, the European stock market kept driving it higher, and then the U.S. stock market kept driving Alibaba lower. This seems to be the norm lately. We have been discussing that on Discord as well, and overall, it looks like it's a little bit of a selling off week, or maybe a couple of weeks lately, but. This is not the important thing that I wanted to discuss in this video. I just wanted to give you a little bit of an update on what is going on with Alibaba, currently sitting at 116. But what I did want to examine is this very, very interesting article here from which we can learn a few things in case we are not really aware of how capital employed works, what it is, and what it implies here. Because you will see that this article over here, this is a Simply Wall Street article, is claiming that Alibaba's return on capital employed is actually worse than the industry average, and it seems to be doing relatively worse as years progress. It does look like that. But is that really the case, and what caused that? If that's the case, we need to examine that in more detail, because people are hearing about this return on invested capital, return on equity, return on capital employed, and they're just looking at a number and they are like, okay, this is higher, so it must be better. But it doesn't really work like this. It's very, very important to understand what this number actually means. And so I will explain in this video. Like, return on capital employed is basically, it tries to give us a sense on how efficient we are with employing our capital as a business. And so the more capital we have to employ, the more we should putting it to work, and the more money it should be generating for us. And so this is basically a ratio that tells us how efficient we are at making money using this kind of capital. And as you'll see, the money is defined here as the EBIT, is basically earnings before interest and tax. It excludes depreciation and amortization, and it's not really the net income here. It's just the earnings before interest and tax here that is accounted for in a return on capital employed. And you will notice that the capital employed is defined as total assets of the company minus the current liabilities. What does that mean? This basically takes all the assets that the company has and actually removes the current liabilities, which is basically the ones that have to be served in the next 12 months, like the short-term liabilities. It's taking more of a long-term approach here. Now, as you can understand, taking a little bit of a first look at this, you can quickly understand that there are some workarounds that you can do here. Like, for example, if you define some of your non-current liabilities as current liabilities, you can of course affect this number over here. There are some ways that you can actually go around potentially, kinda modifying this number at will in some situations. But overall, it's working nicely. And the important thing about this one, again, it kind of gives you a sense of how much you are making, and actually correlates that to the amount of capital that is getting employed in the business. Now, you may be wondering why Alibaba's return on capital employed here is 6.7%, while the industry seems to be 11%. Well, couple of years back or so, maybe 3 years ago or so, Alibaba's return on capital employed was actually near 20% or something of that sort. And there is a reason for this, which we are going to examine. It's a very, very well-known reason. But again, just taking a little bit of a look at this, you may be feeling stressed. Now, let's take it back a little bit and examine what happened in the past. Remember that Alibaba Group 2022 net income drops nearly 60%, if you remember, to 9.77 billion. We can take a look at it in our tool here. if we take a look at the financial statements, we can go to the income statement, and this is a thing that we have seen, that the fact that net income has dropped significantly for Alibaba than the previous years. Now, one important thing to notice here is that the previous year where net income was at these levels, it's actually a little bit more, was back in 2018. Yet the company had a revenue of 40 billion back then, and now it has a revenue of 135 billion almost. So it's much, much more, indicating that the company may actually have been losing money compared to what they have been doing, or they may have been spending some more money potentially in order to get a larger market of the pie, a larger pie of the market pretty much. But what actually happened is what we want to know. So what happened here with Alibaba is that they had quite some write-offs, and of course they also got affected by China and all the lockdowns, all the crackdowns. I mean, their business was severely affected, as you can understand, and so they had to post less net income. But you will see that the group linked this to net losses that stemmed from decreases in market prices of their equity investments in publicly traded companies. And so this happens when you are taking a write-off. You have to reduce it. It's an expense. It's actually written off in from your net income. And so this is more than likely not going to happen again in the next fiscal year. And as you can understand, the return on capital employed will increase again. And this is why it's very, very important to see what is happening with the company overall, and not just take a look at this pretty much a number here, ratio, and be scared because you are looking at it going down. And one important thing to note here is that in the year ended March 2022, we have talked about it as well, Alibaba basically saw its China commerce segment grow by 18%. And you will see that over the same period, Alibaba recorded a 19% year-on-year increase of its revenues, is what we talked about earlier. That revenue actually increased here at 134 billion, significantly from the past years. And so I kind of want you to take a little bit of a look at this and kind of make a video to explain how it works, because Alibaba has been talked about a lot, and a lot of these articles keep popping up claiming all sorts of things. And while this is true, actually the actual numbers are true, and of course this 6.7% changes a lot depending on what time you are using, because it's based on the balance sheet. So the balance sheet, as you can understand, changes all the time. And so, the moment you are looking at this is probably already outdated, but this is just how it works. However, it does tell you that return on capital employed has gone down, yet you need to understand why, and we need to understand why. And this is why we're taking a closer look at what happened with Alibaba here, and not just rely on a single ratio to make our investment decisions, because if we did that, we may have lost the plot. The fact that Alibaba has been trading at a record low, at a very, very low price, doing tons of revenue, and just, they had some write-offs, they had a decrease in net income, but does that really affect the actual business itself, especially when it's coming off of lockdowns and crackdowns in the Chinese economy? I don't think so. I actually think that Alibaba is super cheap right now, and this is why it's one of my top holdings. So that's what I wanted to talk about in terms of Alibaba. Hopefully that helped you a little bit. If it did, if you learned something from it, or if it was interesting to watch, please leave a like and subscribe. And remember that you can always become a patron and get access to this tool that we are basically developing pretty much every day. So thanks for watching again, and I'll see you soon. Bye-bye.